Question 15, Webster. Nice little cash budget question from paper 2 in June 2020. So it's in section B, worth a total of 14 marks. Webster is a sole trader and has provided the following budgeted information. And if we just cast our eyes over what we're asked to do, we're asked to prepare a cash budget for Webster just for the month of January. So although we've got information for 3 months there, we only want to be doing the cash budget for January. Now, it tells us that sales are made on the following basis. 20% of sales are on a cash basis, okay, with a 3% cash discount. So that means that in January, he will receive 20% of January's sales, but minus a 3% cash discount. Don't try and net these off against each other and come up with 17%. That won't work because the 3% is on the 20%, the 3% isn't on the whole lot. Okay, so what I would suggest we do, rather than sort of doing too much to and fro, actually start with the cash budget here. Put a pound sign at the top there, and let's have a little heading here, receipts. So looking at the month of January, cash sales. So for January, it's going to be 60,000 times, whatever it was, 20%. Okay, and then minus 3% of that figure to get the cash discount. So we're going to go for 60,000. Oops, let's try that again. 60,000 times 20% is £12,000 times 3% is 360 cash discount. So he's actually going to receive 11,640 in respect of January's sales. 60% are on a 1 month credit basis. So he's going to receive 60% of December's. So that's going to be 55,000 times 60%. Always worth showing your workings just in case you're as bad as me with a calculator. You get the wrong answer. £33,000 going in there for December's sales. And then November, so 15% are on a 2 month credit basis. So in January, 1, 2, he's going to receive 15% of November's sales. Okay, so 48,000 times 15%, £7,200. Okay, so that's the sales income dealt with. That's going to be his main source of money coming in, I should imagine. We could just scan our eyes down and just make sure that he's not planning to introduce any capital, that there's no other money coming in. I don't think there is in this question. So then we can work out the total receipts. And I remember if we were doing an income statement, we'd be putting it in strictly in the month. If we're just doing a budgeted income statement for the month of January, then it would include January's sales. Because this is cash, a cash budget, we need to find the amount of money actually received. So that's why we need 3 months worth of sales figures. Okay, so I reckon 51,840 is the total for our receipts. Then we can move on to the payments. So remember, this is actual money going in and out. So we don't want things like depreciation going through here, but we will want most other expenses. Okay. Now it tells us that a provision for irrecoverable debts is calculated at 5% on all sales. Well, the provision for irrecoverable debts, if you remember, it is just a provision like the provision for depreciation. So we don't actually need to include it in a cash budget. We would need to include it if we were doing an income statement. We definitely don't want it in a cash budget. So just ignore that one. It is a red herring. Half of all purchases are on a cash basis, with the other half being paid on a 1 month credit basis. So that means that purchases is going to pay half of January. So purchases for January are 36,000. Half of that is 18,000. And then he's also going to be paying in January for half of December's. So half of 30,000. 15,000. I think we need to worry with the calculator there. So that's the purchases dealt with, no cash discount, nothing else to worry about. Wages were £6,000 in December and are paid in the month incurred. From January, they will increase by 2.5%. So wages are going to be based on December's wages. So that's £6,000 plus 2.5%. So 6,000 times 2.5% is an increase of 150. That means he's going to be paying £6,150 in wages in January. Okay, so that's number 4 dealt with. Tick them off as we go along, see what progress we're making. A loan of £45,000 is being paid in equal monthly instalments over 5 years. Well, 5 years is 60 months, 12 fives are 60. Interest is charged at a rate of 5% per annum and is calculated and paid monthly on the basis of the outstanding balance at the start of each month. The amount still owing at the 1st of January was £18,000. So we've got 2 bits to do here. We've got the loan repayment. Okay, so this is the capital that Webster is repaying. So £45,000 divided by 60 months means that he is paying £750 worth of capital, and then he's going to pay some loan interest. Now that's going to be based on £18,000 at a rate of 5% per annum. Okay, but we're not going to charge him 5% because this is only 1 month. We're only doing the month of January, so times that by 1/12, divide by 12. So it looks a bit scruffy now. £18,000 times 5%. £900 is the annual interest, but if we divide that by 12, he's only going to be paying £75 in interest in January. Okay, that's number 5 done. Non-current assets have a cost of £60,000 and an estimated scrap value of £12,000. They're being depreciated at 20% per annum using the straight line method. Well, we can just ignore all of that. The only thing we want in here, remember, is payments and receipts. So if he sold an asset during the year, or during the month, if he was planning to sell an asset during the month, we would need to include that as a receipt. If he was planning to buy an asset during the month, we would need to include that as a payment. Depreciation, it's a non-cash adjustment, so it has no place in a cash budget. Leave that for the income statement. Okay, now expenses including depreciation are £15,000 per month and are paid in the month incurred. Now, just as we thought it was safe to ignore this one, we now realise that actually we're going to need to work out what the depreciation is and take it away from there. So non-current assets have a cost of £60,000 and they have an estimated residual value or estimated scrap value of £12,000. So that means they're losing £48,000. And then we're going to times that by 20%. We're writing those off over 5 years. So 48,000 times 20% is 9,600. Remember, we need to divide it by 12 to find 1 month's worth. So the depreciation is £800 for the month. So we're paying £15,000. So the expenses are 15,000 minus £800 of depreciation, which is 15,000. I don't know why I'm using a calculator for this. £14,200. I really ought to have been able to do that in my head. But it's Friday afternoon. It's quite late. I'm quite tired, so I'll let myself off. Right, number 8, cash drawings are taken each month based on 8% of monthly sales. Now, do not be tempted to go and look up here for the sales. Go back to the sales for the month. So drawings are going to be, remember, drawings would never go in an income statement, but they will go in a cash budget because it's going to result in an outflow of cash. Cash drawings, 8% of monthly sales. Well, the monthly sales for January, 60,000 times 8% is going to be £4,800. So I didn't use my calculator for that one. Hopefully it's right. And then it tells us that the bank balance at the 1st of January was 1,250. Well, we're going to need that in a mo. Let's just total up our payments. So bear with me while I sling all this into the calculator. So 18 plus 15, 6150, 750, 75, 14,200, 4,800. His total payments are 58,975. Now at this point, I would be tempted to work out the net cash flow. So starting with the receipts and deducting the payments. In this case, it's going to be a negative cash flow because he's paid out more than he's received. Balance at the 1st of January is the balance they gave us here, 1,250, and then we can come up with the balance at the 31st of January, which is the difference between the two, 5,885. So hopefully that's given you a few tips, things to avoid, pitfalls to avoid, red herrings to ignore in order to get the right answer with the cash budget. Thanks very much for watching. If you've enjoyed the video, please don't forget to like and subscribe. See you again soon.